How inflation affects stocks, bonds, and Forex. Mike Butler, I don't know if you've heard about this. You're pretty tapped in. You host a daily trading show. I see you all over Twitter, great Twitter account. You're all over YouTube talking markets and everything. Have you seen this inflation? People are starting to think it's a problem. Have you seen this?
I have, yes. I have seen that vertical bar known as inflation. And I've seen it in the real world too. The price of things has just got skyrocketed, and it's like, what in tarnation is going on? But yeah, highest in 40 years is a little alarming. And I feel like the Fed has their backs against the wall. They feel like they need to do something to control this, and what that is, we'll have to see going through the rest of the year. But I've been saying that I think you might see a lot of movement in the next 2 weeks, just because a lot of these high beta stocks have earnings coming out, like Apple, Microsoft, all those, with Tesla and Netflix coming out this week. So if you see big moves, especially in one side of the market, like if all of them sell off or if all of them rally, I think it will speak volumes to what we see these interest rate numbers move to too.
You're absolutely right on all of those topics. I mean, first of all, obviously, inflation is the highest it's been in 40 years. Of course, I'm joking. If anyone's been around Twitter or financial markets or whatever, everybody's talking inflation now. We've been talking, though, interest rates and US dollars in these markets that they're affecting for a while now. And Mikey nails it, which is the first thing that I think of with this inflation. What is the Fed going to do? Or more broadly, what are central banks going to do? Because the central bank, whether it's the US or the Eurozone, the ECB has a rate decision this week. So does Bank of Japan. The Bank of Japan has its own host of problems. They're probably not going to change anything, but the ECB likely to hike. And so you're totally right that the first thing that I would think of is interest rates. What is the Fed going to do? What is the ECB going to do? What is the Bank of England going to do? And so on, because inflation, the most direct cause, at least in my mind, as a trader and as someone who's been around markets, is inflation being low. A lot of times leads the central bank to keep interest rates very low to try to inspire more buying and selling and exchange of money and just more growth in markets. When inflation is high, that causes central banks to increase interest rates to kind of reduce that flow, to try to calm prices down. Because as Mike Butler, you noted, things in all of our lives are more expensive. I mean, energy prices are crazy. Food prices are also climbing like mad. And interest rates moving higher can work to counteract that. But you bring another great piece up, which is stocks, though. This is the next piece, because the Fed, the two things that they have to fight are inflation and recession. And higher interest rates mean stocks have to spend more money to take loans out and everything else. And so it can move stocks lower. And we've seen that this year. The high inflation indirectly is causing stocks to slide a little bit because of those higher rates, right, Mike Butler?
Yeah. And it just, like you said, it de-incentivizes people to throw their money in investments. And even if you think about like the rising cost of goods and services, that just means less money to invest in theory for your retail investors and things like that. So there is a direct inverse correlation here that we're clearly seeing. But again, what will happen through the rest of the year will largely be affected by what the Fed does with that rate.
Yeah. And this is where like the great trade is. Like, why is it so volatile? Is because people every other day, it's like, oh, the Fed is going to increase rates to fight inflation. Oh, actually, never mind. They're going to reduce rates because they're worried about a recession. And with that back and forth is great trade out there for everyone. A market that the last piece here, and it has, again, similar to stocks, a little bit of an indirect effect, is the foreign exchange market. This has been maybe the most volatile piece, the most opportunity. US dollars going to highs since 2002 against the euro, since the 90s against the yen. And you might think high inflation, that shouldn't lead to a high currency price. If a region is witnessing high inflation, Mike Butler, a textbook would tell me that their currency is depreciating, but this is a little nuanced, and that's where that indirect thing comes in, which is the U.S. is currently the strongest of the major economies, and so though it's high inflation and euro is being driven down, yen is being driven down, British pound is being driven down, Canadian dollar, Australian dollar, something has to appreciate. This is a game of relativity, right? All of those currencies and the US dollar can't all just fall against what? They're all falling against the US dollar. And because the US has the highest interest rates of the major economies and is thus kind of thought of as the strongest of the major economies, this US dollar has been moving higher with inflation as well.
Yeah. And what's crazy about the US dollar is that it's generally a very low implied volatility product. Like even right now, the SFX implied volatility is almost 7%, $2.50 expected move for the next 30 days. But we've seen those moves be much greater than the implied. And that's where you're getting, these crazy moves and these new highs coming to fruition. Is just the realized volatility has been exceeding implied volatility, which is pretty rare for something like the US dollar.
Extremely rare. I mean, this is quite literally the most interesting, the most high vol, the most opportunistic market, not only in terms of foreign exchange, but these interest rates like we talk about. Stocks, not quite there yet, but close. Since the early aughts for at least, 10, 20 years. And it's all stemming from this inflation. So quick recap, inflation most directly is going to affect your interest rate environment. But from there, it becomes pretty nuanced as to how interest rates are going to affect stocks and going to affect foreign exchange. And right now, this nuanced situation seems to be higher inflation, higher interest rates, especially here in the U.S., leading to strength in the U.S. dollar and weakness in the stock market as they're worried about higher costs for loans and everything else. And it tends to snowball. To your point, Mike Butler, people on the ground have less money that they want to put into trading or investing or what have you. That inflation fear is making people, fearful just of everything. They don't want to buy as many stocks and everything else. So it'll be interesting to see if this 40-year high is the high. You would expect all of these markets to reverse a little bit, but that is our current situation of how inflation affects markets. Mike Butler, thanks so much for joining me. As always, you can catch him all over the Tasty Trade Network, one of the premier talents of Tasty Trade, and also on Twitter. He's always posting trades, earnings trades, and everything else. So make sure you're following him there and follow the Tasty Trade Network into the next segment, Splash into Futures, coming up next. Thanks everybody for watching. Have a good night. Peace.